All right, everyone, welcome. So, every single business out there, I don't care if it's a tiny coffee shop on the corner or a massive global company, has what I like to call a financial DNA. It's this unique code, right? It dictates how every single dollar flows, how every decision gets made, and really how the whole story of that company is written. Today, we are going to decode that DNA. We're diving deep into the chart of accounts.
Before any manager can decide to launch a new product or an investor can confidently put their money into a stock, they have to be fluent in the language of business. And I'm not just talking about buzzwords and jargon. I'm talking about a fundamental structure that takes all the financial noise and turns it into clear, actionable intelligence. That structure? That's the chart of accounts. And honestly, understanding it is your first real step from just being a student of business to becoming a leader in business.
I want you to picture a popular coffee shop. It's a busy Monday morning. Every single latte they sell, every bag of beans they order, every paycheck they cut for their baristas, every electricity bill they pay, it's just a constant storm of financial data. Now try to scale that up in your mind to a company like Apple or Toyota. The amount of data is it's staggering. And without a system, it's not just messy, it's completely impossible to make any kind of smart decision. It is pure chaos.
So the solution to all that chaos is the chart of accounts, or what we call the COA. Now this is not just some simple list. Think of it as the essential architectural blueprint for a company's entire financial world. Every single transaction, whether it's buying a $1 pen or a billion-dollar company, gets categorized right here. It's the master index that brings order to that financial storm, and it allows us to build the reports that managers, investors, and banks all rely on to actually understand what's going on.
Okay, so just like any good blueprint is built on core elements, walls, floors, a roof, our financial blueprint is built on 5 core account categories. And let me be clear, mastering these 5 isn't just important, it's completely non-negotiable for anyone who's serious about business. They are the absolute building blocks for every financial report you will ever look at. So let's break them down, one by one.
First up, assets. So what are they? Simply put, these are the economic resources a company owns and controls. It's the cash sitting in the bank, it's the delivery trucks they own, the computers on everyone's desks, and all the products sitting in the warehouse. But here's the crucial phrase I want you to remember. Future economic value. An asset is anything the company has that it can use to create value down the road.
Next, we have liabilities. And this is the flip side of the coin. If assets are what you own, liabilities are what you owe. These are the claims that outsiders, like creditors, suppliers, and banks, have on your company's assets. So, a loan you took out to buy that new equipment, that's a liability. The bill you haven't paid yet from your coffee bean supplier, that's also a liability. They represent a future obligation, a promise you've made to pay. Tracking these is absolutely critical for managing a company's financial risk.
Third is equity. Now you'll hear this called a few different things: shareholders' equity, or maybe the book value of a company. Conceptually, it's pretty simple. It represents the owner's slice of the pie. After you account for all the liabilities, all the money you owe to everybody else, whatever is left over belongs to the owners. In our blueprint analogy, this is the owner's actual stake in the finished building.
Now what's so cool about this is how these first 3 pieces are locked together by the single most important rule in all of accounting. Assets equals liabilities plus equity. I want you to really think about that for a second. It's not just a formula to memorize, it's a statement of pure logic. Everything a company has, its assets, had to be paid for somehow. It was either financed by going into debt, which is liabilities, or it was financed by the owners putting their own money in, which is equity. There is no third option. This equation isn't just a rule we decided to follow, it's a fundamental truth that must always be in balance. Every transaction you ever record will have to keep this scale perfectly level.
All right, our 4th category is revenue. This is the lifeblood of any business, right? This is the good stuff. It's the inflow of assets, usually cash or sometimes a promise of cash that we call accounts receivable, that a company gets from doing what it does best, like selling its products or services. When a business earns revenue, it's actually increasing its own value, which, in the end, increases the owner's equity.
And finally, number 5. To generate all that great revenue, you gotta spend money. That's just how it works. These are your expenses. They are the costs of doing business. Things like salaries, rent, marketing, utilities. And here's a really critical accounting concept, the matching principle. It says we have to record our expenses in the same period as the revenues they helped us earn. Now, why do we do that? Because it gives us a true and accurate picture of just how profitable our business activities really were during that specific time.
Okay, so we've got our 5 main categories, our 5 big buckets. But a real company, as we talked about, might have hundreds, maybe even thousands of individual accounts. A specific account for office supplies, another for fuel for the trucks, another for sales to a specific customer. I mean, how do you possibly keep all of that organized and prevent it from just turning back into total chaos?
The answer is actually pretty elegant. A logical numbering system. Think of it like the Dewey Decimal System at a library. Each account gets its own unique number that doesn't just identify it, it also tells you what kind of account it is and where it fits in the grand financial blueprint. This system gives us precision, it allows the company to grow and add new accounts easily, and it's the absolute key to automating all the accounting work we do in modern software.
Let's look at a typical structure, because this will make it crystal clear. Asset accounts, they might all start with a 1. Liabilities all start with a 2. Equity with a 3, and so on. So cash might be account 1010. A bank loan could be 2020. So if you see a transaction coded to the 5,000 range, you instantly know, that's an expense. This isn't just to be neat, it's brilliantly logical. The numbers follow the same order as the financial statements. Balance sheet accounts come first, assets, liabilities, equity, and then the income statement accounts, revenue and expenses. This makes it incredibly efficient to pull data and analyze how the company is doing.
So we've got the theory down. We have the blueprint. We have its components. But how does this all actually work in the real world? Let's put you in a manager's chair for a minute. Let's say you run a successful bakery. Your old oven is just not cutting it anymore, and you're thinking about making a major investment in a brand new, state-of-the-art one. How do you make that decision?
Well, a smart manager doesn't just go with their gut feeling. They open up the blueprint. They ask very specific questions. Okay, if we do this, what's it going to do to our cash? Do we have enough? Are we going to have to take on a new loan? And if we do, how does that affect our monthly payments? How does this one purchase change our company's overall financial health? The answers to these make-or-break questions are not in your gut. They are sitting right there in the chart of accounts.
So you have 2 paths. On one side, there's the gut feeling decision. It just feels like the right time. This is so incredibly risky. On the other side, you have a decision that is guided by the blueprint. You pull up your accounts. You look at cash, account 1010 in the 1000 series for assets, to see what kind of down payment you can handle. You analyze how a new loan will increase your loans payable account. That's 2020 in the 2000 series. You project how that new oven will increase your equipment asset account. Maybe that's 1500. See the difference? This is what turns a wild guess into a calculated strategic business decision. Now, before we move on, I want to talk about a very common mistake I see students make. It's an easy trap to fall into, but it has some really big consequences. Let's say instead of buying a new oven, you just paid for a major repair on your old one. Now, if you incorrectly record that repair cost, which is an expense, in your equipment account, which is an asset, you've created a serious problem. You are making your assets look more valuable than they are, and you're making your expenses look lower than they are. This makes the company look healthier and more profitable than it actually is. But the damage doesn't stop there. Every single future decision based on that flawed data, every budget, every loan application is now compromised. Precision in your blueprint isn't just a nice-to-have, it's an absolute necessity. And I want to be very, very clear about this. The chart of accounts is not just some tool for the accounting department tucked away in a back office. I don't care if you become a marketing director, an operations manager, or the CEO. You are going to need to understand this blueprint. You will use it to build your budgets, to justify your projects, and to measure your team's performance. Being fluent in this language is a non-negotiable prerequisite for leadership.
So I'll leave you with this question. The chart of accounts gives you a perfect, detailed story of where a business has been and where it is right now. But its true power isn't in looking backward, it's in shaping what comes next. As you move forward in your careers, the real question isn't just if you will use this blueprint, but how. How will you, as a future decision-maker, read this financial story not just to understand the present, but to actually architect a more profitable, more sustainable, and more successful future?